So, Tom, we said this a bunch of times. The market seemed to be shrugging off the shutdown, valuation concerns. What do you think is going on? Why do investors just continue to feel confidence?
Well, Frank, I think there's two underlying fundamental drivers for the economy. One is that we know there's a tremendous capex tailwind from AI, and the second is that the Fed's been on hold for 9 months, and it's kept the ISM below 50 for now 31 months, and the Fed's dovish. So that's the rest of the economy getting basically a lifeline. Those are going to be powerful tailwinds that even a government shutdown doesn't really change the story around. And now that we're in the seasonally strong fourth quarter, and valuations, I just don't think are that demanding because, NVIDIA is still at 26 times earnings. I mean, I think stocks still have a lot of upside into year end.
All right, really quick. You're talking about ISM manufacturing, right? Still in contraction. You're saying the Federal Reserve rate cuts, if we stay on this path, that boost the manufacturing sector. Is that the point you're trying to get to?
Yes, that's right.
Okay.
So the manufacturing sector has been cautious for 31 months, the longest stretch below 50 in history. And, that's business confidence. It's highly correlated with earnings growth. So I think once that moves above 50, that means we're back in expansion mode, and it's good for financials and small caps, and the tech trade continues. So I think it's a broad-based rally.
I think a lot of people think it would be good for transports, energy prices. I think, as you mentioned, it would have impacts across the board if we see a boost in U.S. manufacturing. Okay, I want to get to your word of the day. It's dovish. Now, this is interesting. Your word's dovish, and you're dovish because the Fed didn't get the jobs report and might not get other reports. Why are you dovish, or you think the Fed's dovish, despite that critical information?
Well, the Fed has, I think, on balance, has to be more dovish than what they said they would be last month, because a government shutdown, as you know, disrupts economic activity. So even though they're not getting reports, there's also a standstill in GDP, and the government is a very large share of GDP. On top of that, it causes confidence to be weaker. A shutdown makes people nervous, and so the Fed will have to be even more dovish, and I think that's why stocks can rally even more than they have already.
All right. You're also looking at seasonality. You alluded to it earlier. According to your data, since 1950 in Q4, we see just about an average rise of about 5%. But when we're talking about seasonality, are you sure this isn't an outlier year? As we mentioned, a government shutdown, companies trying to deal with tariffs. We're seeing a trade war between the U.S. and China continue. It hasn't quite been resolved yet. I mean, aren't there some issues that could maybe shake the seasonality here?
Yes, that's right. I mean, seasonality is just a base case. So things can make it different. But this year, we're going into the fourth quarter where sentiment, I think, is still really muted. If you look at things like AAII net bulls, it's barely positive. After a 30% rally in stocks, historically, you'd be solidly positive on a 20-week moving average of that number. Investors have really been skeptical this entire rally. That's why we call it the most hated V-shaped rally.
All right, I'm going to get to your pick as well. Your pick first today is financials. Now, is this on the idea that the Fed is dovish, rate cuts help, boost the yield curve, and that helps financials, or is there some other reason that you're seeing that you would put money into financials right now ahead of earnings?
Well, I think financials have also fundamental tailwinds because we know the Fed is going to be dovish, which is helpful for economic activity. But on top of that, AI is a tool that the financials industry can leverage. It's going to help them root out fraud. It's going to help make their businesses more profitable. And it's something we've talked about at Fundstrat, which is the financials may end up getting technology valuations, especially given blockchain and moving from traditional financial rails onto blockchain and becoming more efficient.
All right. You're also a big believer in Ether. So you're saying financials companies especially, you say, are building on Ether. Is that a tailwind somehow? The fact that they're building? Oh, sorry. Did I cut you off?
Yes. Yeah, absolutely, Frank. Keep in mind, Exhibit A in all this is Tether. It's the largest stablecoin issuer in the world. It's valued at $500 billion, or about 25 times earnings. It makes it the second largest bank in the world behind JP Morgan. And it shows you that by building on the blockchain, a business can really reduce cost and be a lot less employee intensive. Tether only has 300 employees compared to JP Morgan, which has 313,000 employees.
Okay.
So Tether is valued at around 1.8 billion per employee. JP Morgan around 2.6.
Okay.
So you can see the leverage coming from Ethereum.